Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors. July 9th, mid-afternoon on Friday. In terms of what we saw this week, a little dose of volatility introduced back into the equity markets. You could say it may have been a result of some of the volatility in yields in the Treasury market, right? We saw yields 3 and 4 months ago at 175, 176 in the 10-year Treasury. Got as low as 127, 128 Thursday morning. That represents traders and investors having a little bit of fear that the economy that we watch closely may have already peaked. Doesn't mean the economy is going to fall apart, but maybe it just chugs along from here and that peak growth is behind us. We don't know the answer to that. We do know that that interest rate fear, which is rates dropping, bids in treasuries, did show weakness in cyclicals and some of the names on the equity side that you would expect. You know, important to realize that 10, 15, 20 years ago, when I was trading, if there was a growth scare, and it's tough to call this a scare, but if people were expecting growth to decelerate in the economy, the names that got hit were the growth names, primarily technology, consumer discretionary. Today, different market. When there is a growth fear to the economy, the growth names stay strong. You look at technology, you look at the Qs this week, NASDAQ 100 up 2%, S&P up 1%. Where the damage was done was in value, small and mid, which is the opposite of what we've seen really for the last, 8 or 9 months. We pointed out, we started to see a change in character in this market, equity market, third week of May. And it's continued. Maybe getting to the point where that ratio of growth versus value is getting overbought on the growth side, and there's some bargains on the value side. We'll see. Have mentioned the last couple of weeks that I wanted to just review a couple things from the first half of 21. Not performance. We can all look at performance on our computers. I want to look more at some of the analytics we take a peek at to try to position ourselves mentally in how we manage portfolios. The first chart I'd like to take a look at here is max drawdowns by calendar years. And we have a nice robust study here going back 30 years. You can see 2021, which is the far right of the slide, we have a very mild 4.23% max drawdown in Q1. This is something that has spurred some media and investors to say, well, we have a larger drawdown coming. If we've had that low volatility in the first half, the second half is where you have to prepare for some damage. But what we found is that's not necessarily the case. If we pop over to the second slide, on the bottom half, you have max drawdowns in the first half of calendar years. And these years aren't sequential, as the previous slide was. These are by percent. So you can see that if we look to the far right, the highest max drawdown in the first half of any calendar year, the last 30 years, was last year. S&P from peak to trough was down over 30%. What I want to point out, though, is when you notice from the left-hand edge over, when we get mild volatility in the first half, it doesn't necessarily mean that we're going to have increased volatility in the second half of the year. What this slide is really telling us as traders, as investment managers, is remain flexible. There are no rules that if volatility, as represented perhaps by the VIX, is low in one half of the year, it's going to pick up in the next, or vice versa. We have to trade what we see day to day, week to week. In terms of how we're positioned right now, we have seen some weakening, as I've mentioned, in small and mid cap, have seen some weakening in value. We have raised some cash in our U.S. portfolios. We're at about 15% cash. We wanted to draw value down a bit to leave ourselves a little heavier on the growth side. So that's what we've done. That money is available and ready for different opportunities. And as I mentioned, it may be back in specific value names. For the time being, we'll let them churn. In terms of international, we're really only 2 or 3% cash. We consider that just about fully invested. What we have done, though, is our last 2 or 3 buys in international have been on the developed side. We wanted to get heavier on developed versus emerging. Emerging continues to weaken versus developed. So we want to be longer and stronger on developed versus emerging in our international portfolio. In terms of our tactical portfolio, tactical trend, we remain heavy growth. We're a bit overweight technology. Things are working well, both on the indexes and the individual side. When we flip over to our quant strategies, remember, they're dictated strictly by quant work that Dr. Leo does for us here. And right now we continue to be on the latest signal, which is a buy signal. Got that buy signal about 2 months ago. In terms of what happens if there is a sell signal or if we hit our target, that quant strategy goes to cash and awaits the next signal. So let's see what the next 5 days bring. In terms of interest rates, should be very interesting. We saw that 10-year Treasury back up to about 134 today. Really felt oversold in the 126, 127 area. Should be fun. Have a great weekend.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. I'm filling in for John Musso today, who's on vacation. Today is Friday, July 9th in the mid-afternoon. So it was a holiday-shortened week. A lot of people were on vacation, and maybe it made the market a little bit more volatile, but we also reached new highs in the stock market. And after Wednesday's FOMC meeting, with inflation seeming possibly that it will be transitory, that the Fed's not going to move too much, that people became a little concerned that our economy may slow down more than expected because of an increase in virus and variants. And also seemingly supply chains aren't as gunked up, or people are thinking that they might not be as gunked up. Things are kind of getting back on track. So that all led to lower bond yields. Treasury ended, the 10-year ended at about a 135, and the 30-year ended at 198. Now I wanted to just show you a chart that the levels that the bond market went to were about the same levels as they were in February. But if you look at a year ago in July, rates have kind of been on an upward trend, although the past few months it's been on a downward trend. I think you've heard us say before, Cumberland, that we do expect rates to creep up slowly over time as we kind of get back to a more normal economy. Moving to municipals, municipal yields also went down considerably. There's also, July is just a month where there's a lot of maturities of bonds and interest payments and not as much issuance. For example, this week there was very little issuance, and so there's a lot of demand. All those maturities and interest payments want to be reinvested back into muni bonds, and we know that muni bonds have also been performing well because people are afraid that they're going to be having higher taxes going forward, not just at the federal level, but at the state level. So that's been constructive for municipal performance. It's also made spreads tighter, so it's hard to find value, and a lot of people are chasing yield. So going forward, it seems that credit quality of munis should be good for a while, given the amount of the stimulus, the record amount of revenues that they've been collecting, sales tax revenue, income taxes. There are going to be expenses, though, and things for people to look at going forward. Because there's been so much demand for munis. The muni treasury ratio is pretty low. It's at 62% for the 10-year and about 67% for the 30-year. This week, we also had initial jobless claims this week. That's a number we always look at, and it was at 373,000. It was higher than expectations of 350,000, but it's still in the 300,000 level. Next week, we'll be looking for CPI. We're going to look at, of course, year over year. I think it's expected to be about 4.9%, but month over month, more like 0.5%. And remember, we're looking at the cumulative month over month, not the comparison from a year ago when everything was still very slow. So I hope that everyone had a nice holiday shortened week. Enjoy this weekend, and we'll get cracking next week. Muni supply is going to be about $9 billion. Only 2.6 is taxable munis, so it'll be good to have some supply there for our market to trade. Thank you, and have a great weekend.